fundsupermart.com.
Hi Joanna, how has the fund performed so far in first half of 2014? And going forward, will there be any significant changes made to the fund strategy?
The fund has performed pretty well so far this year. Up to 30th of June, the fund has returned 5.35%. And the two key asset classes that the fund is invested into, the Asian dollar bonds and the US high yield bonds, have actually performed very well, returning 5 to 6%. That has actually resulted in this strong performance of the fund so far. And in terms of the strategy for the fund, I don't foresee any material change for the rest of the year. Given the very loose monetary policies that we are witnessing across the world, I think equities and corporate bonds can continue to do quite well. So basically for the fund, we will target for the fund to be fully invested most of the time. And in terms of the asset allocation strategy for the fund, it will continue to maintain a preference for high yield, US high yield bonds over Asian dollar bonds. The US high yield bonds have a higher carry given the higher yield that it has. That should actually provide some buffer in terms of offsetting any potential negative effects from a rise in interest rates. And if indeed there is actually a rise in interest rates which may negatively affect fixed income, that should actually be quite positive for US high yield corporates from a fundamental angle, given that in terms of its corporate earnings as well as ability to service its debt, that should actually be better, and that should reduce the overall credit default risk. So we are still going to express a more positive view on US high yield in favor of this asset class over the Asian dollar bonds. And in terms of the equity allocation for the fund, we will continue to maintain about 10% into dividend stocks, given this sector has actually cheapened up quite substantially sometime last year, in the middle of last year, if you can recall, because of the taper tantrums. The sector has cheapened quite a bit, and we believe that in terms of the dividend yield for the sector, it's still attractive, and we will maintain a 10% allocation to this sector.
Which sectors or companies have been contributing to the fund's consistent dividend payout?
Yes, US high yield bonds as well as the Asian dollar bonds both have actually performed very well, as I mentioned. So in terms of the coupon income and the capital gain of these two asset classes have actually contributed in a large way to allowing the fund to meet its target payout. And as the fund is also invested into dividend stocks, this one has an average of about 5 to 6% in terms of dividend yield, and so that has gone a long way in terms of helping the fund to meet its target payout of 5 cents per unit as well. So yes.
Can you share an example of a good call and a bad call made by the fund?
Well, so I will first start with perhaps the Asian dollar bond sector. So within this sector, the fund has actually increased its allocation to long-dated investment-grade corporates earlier this year when interest rates rose and the yield curve steepened. So following that, the yield curve actually flattened, and so this sector has actually done pretty well. So that was actually a pretty good call on the fixed income side. And of course, generally speaking, the asset allocation call to be invested into dividend stocks, which is a off-benchmark allocation for this fund, that has actually also contributed to the fund performance and has been a pretty good call. The equity portfolio has returned about 10%, which has outperformed corporate bonds and cash in a very material fashion, so that's a good call. And in terms of equity holdings, stock-specific good call, I would say Singpost would have been a very good call, given that we actually bought this counter late last year into this year. We were actually positive on the outlook of the company, given that it was actually transforming its traditional mail business to more of e-commerce and logistics. And at the time, the dividend yield was very attractive as well, at about 5%. And so we actually bought a position into this counter. And since then, it has actually performed very well, returning more than 30%. And we have actually since cut that position. And in terms of bad call on the fund, I think the fund was actually underweighted Asian dollar bonds into cash. And that would have been a bad call from an asset allocation strategy perspective, given that Asian bonds continue to do quite well this year, outperforming cash. And within the equity space, I've actually talked about a good call. Conversely, in terms of a bad call, I think our position in StarHub has been an underperformer. We added to this counter because of the pretty attractive dividend yield of about 5%, but that counter has actually been underperforming the broad market. Year to date so far, it has been flat when the rest of the market has actually been moving up, in part because of the concerns of increasing competition in the broadband space. Notwithstanding this stock not having done as well as we would have wanted, we will continue to actually hold on to this position, given that the dividend yield is actually still pretty attractive for the fund.
Investors are hesitant towards bond fund given that bond yields have declined recently. Why should investors invest into the monthly income plan fund now?
Sure, I think that's a very good question, given that we are also in agreement with investors that we should actually be mindful of the potential risks investing in fixed income assets, given that the monetary policy cycle is expected to turn, although timing is still questionable. And also given the very low interest rate environment at the moment, obviously risk is mounting that interest rates will rise and that will negatively affect fixed income assets. But in our view, in terms of the whole interest rates rise timing, I think that's still a big question mark. Even though the Federal Reserve has said that they are going to reduce their asset purchase program, but that is actually a reduction in excess liquidity. At the margin, it may cause an upward bias in terms of interest rates, but in terms of the explicit interest rate policy, they have basically reiterated their commitment for a low interest rate environment, and it is not our expectation for them to actually increase interest rates within the next one year or so. And this is really on the back of very benign inflation outlook. So we believe that interest rates can still stay low for a while longer. And also given the very steep yield curve, it may not necessarily be a case where a rise in short rates will be proportionately priced into the long-dated bonds as well, given the huge sort of buffer for any increase in the short rates, as long rates are actually pretty high still. So we do not believe that the market will correct in a very violent fashion. I think the risk there is actually pretty contained, although we do think that over the medium term, the bias is definitely there for interest rates to rise. And I would also like to add that given that the monthly income plan is actually not a pure fixed income fund, it is a balanced fund that allows dynamic asset allocation between equities, corporate bonds, and cash. So fund manager is actually allowed to move between these asset classes depending on market conditions, market valuations, and our macro outlook. So if you were to compare this to a pure fixed income fund, then obviously the risk is a lot lower in terms of the impending increase in interest rates. And given that the monthly income plan has a diversified fashion in terms of investing into these various asset classes, we believe that it actually does offer a more attractive risk-reward characteristics compared to other funds which may be invested only in one single market or one single asset class.
Thank you.
Thank you.